ahead, cost volume analysis. See, what is cost volume analysis is, what is cost is the expenses or the investment for your manufacturing unit. Okay, and volume refers is the number of quantities being produced in any manufacturing units, or okay, any business unit you would consider. Okay, so it is an analysis of location based on the two major components, which is cost involved and output produced in manufacturing units. So with respect to cost, we have two different cost: fixed cost, which are remains the same no matter how much a company produces. Say equipments, example equipments, buildings where you have invested. Okay, so see, every year the cost of see, so when once you have invested 1 lakh rupees in an equipment, so whatever the number of produce, or whatever the number of volumes you produce, the price is going to stay the same for you, the expenses is going to same for you. Okay, moving ahead, we have variable cost, which varies with the amount of the units being produced or the output being produced. The example is the labor cost, material cost. Okay, the higher number of volumes, you need a higher number of raw materials, you need, more in terms of human being resource. Say example, in job shop production, we have, a single, we need the job shop production is, much oriented on human skill, the skill labor. So somewhere, if you have more volumes to be produced, you need more labels. So again, it depends on the numbers what you produced, and then you're paying for your labor wages. Okay, so that's how, the fixed cost remain the same whatever the number of, or say whatever the volume you produces. Okay, but variable cost, it varies with respect to the number of output you being produced in your manufacturing system. Okay, there are certain assumptions with respect to cost volume analysis. Is assumption are fixed costs are constant, they remain constant. Variable costs are linear. That's what, it remains same, and variable are it's either variations. You see a linear format in terms of ups and downs in terms of cost with respect to variable elements in your manufacturing unit. And output can be closely estimated, where you have a manufacturing unit where you can easily estimate on the output what is required to be produced. Say, you have a clear picture on your demand aspect. Okay, and then only one product involved. This is best suitable method where the production unit is focusing on only single product. Not, it is not really suitable or not favorable in terms of you have a diversified products, or with respect to diversification of products you being produced as manufacturing unit. Okay, so this is simple. Cost volume analysis is an analysis with respect to production plant location based on two major components. Those are costs and cost involved in production and output being produced in your manufacturing unit. Considering, or output could be considered as demand being produced also. Yes, cost, we have two different type of cost: fixed cost as well as variable cost. Fixed cost remains same, or say constant during whatever the number you volume you being produced. Variable cost vary with the number of amount you being produced. Examples for fixed costs are equipment and buildings. Variable cost for is, it depends on the raw materials and the human the labor wages being paid. Okay, these are the intangibles. See, this differs on the number of volumes being produced. And the assumptions are fixed costs are constant, variable cost is linear, and out where we have a clear picture in terms of output, and only one product is involved in production system. So this is the overview of cost analysis. So I'll just explain with the help of a number. So I have taken here as an example of location A, B, C, D, where I have 4 different locations. Okay, 4 different locations. See, this is, the analysis, the survey what we have done, and we have got this data. We have to do a survey, we have to have an analysis of each location in terms of the costs and volume being produced. Okay, so we have a data on the basis of survey. Okay, so fixed with respect to location A, the fixed cost would be 2,50,000 and variable cost is 11 rupees per unit. Okay, in the bracket I have mentioned 10,000, that is demand being produced with respect to that location. I have kept demand constant in terms of, so that we can have a easy in terms of calculations. Okay, so I was discussing location A, fixed cost is 2,50,000 and variable cost per unit is 11 rupees. Okay, and we have a demand to be fulfilled in terms of 10,000 units. We need to produce 10,000 units. So when we multiply variable cost with per unit, we'll have 11 lakh 10,000. So together, see, total cost is always additional whatever the fixed cost plus variable cost, we get total cost. Okay, so this is the total cost which we are going to incur, or we are going to we have to be invested in terms of manufacturing income, manufacturing unit, if we are selecting location. And the total cost what we are going to incur as is 3,60,000. This is with respect to location A. So coming back to moving ahead, location B we have, and fixed cost with respect to location B is around 1 lakh and 30 rupees per unit is variable cost. So we have 10 lakhs units to be produced. So together total cost we have 4 lakhs. Okay, moving ahead, let's see what it is there in terms of data, in terms of the cost and volume being produced. Okay, so a fixed cost is 1,50,000 and variable cost is rupees 20 per unit. Okay, so we have to produce again 10,000 units. So together if we multiply 20 into 10,000, we'll have variable cost together is 2 lakhs. So 2 lakhs plus 1,50,000, we have 3,50,000 is the total cost. And then when we are talking, let's see what location D is involving in terms of fixed cost is, it has a fixed cost of 2 lakhs and 35 rupees per unit. So multiplying it by 10,000 units, so we will get it 3,50,000. Sorry, it has to be 5,50,000. Okay, this cost has to be 5,50,000. Okay, 3,50,000 you will have, and plus 2 lakhs. So your total cost of D location is 5,50,000. So now you have the total cost. You are depending on the 4 alternatives. Among the 4 alternatives, you will be choosing which is right or which is suitable for you, which gives you less cost involvement in terms of production of your products. Okay, so we have all the data. Okay, we have all the data with respect to location A, B, C in terms of total cost. So A is 3,60,000, B is 4,00,000. Sorry, it's B is 4 lakh, C is 3,50,000, and D is 5,50,000. Okay, so let's see this on the cost volume analysis on the graph. Okay, so we have annual on x-axis and the annual output on x-axis, and y is the cost involved. Okay, based on that we have plotted the graphs. If you look at the A, so it is almost the A and C. If you see, you can see the lines being drawn on the graphs, which explains. So somewhere you produce, see this point where we see C and A, so this is somewhere explains as being suitable in terms of production, where we see less in terms of expenses. Okay, so we can produce more than 10,000 with respect to, this is the number of outputs. So that's, I have taken on an average of 10,000. So somewhere it plots between 10,000 and 12,000. So with the same incursion, we can produce more than 10,000 with the total cost of 3,50,000. So considering the total cost of each plant, we see location C is suitable, which has less cost involved in terms of if we select the plant location, plant C, we can be the most benefited in terms of cost aspect. Okay, and the same way if you look at plant location A, it is not much differentiation in terms of the expenses. There is only 10,000 difference in terms of cost. So again you can have the decision which is best suitable. See, according to this data, we can analyze that we can come to a conclusion that location A and location C are the best suitable, which gives us the economic benefits as a production unit. This is all about the cost analysis.